Have you ever fantasized about turning a modest sum into a steady income stream without lifting a finger? Well, your financial daydream may be closer to reality than you think. In today's video, we will delve into the fascinating world of dividends, unmasking how your hard-earned $10,000 can be leveraged to produce a consistent income stream. We'll unpack how an initial investment can make your money work for you, reducing the stress of debt repayment and making that dream trip not a fantasy, but a real possibility. So what does it really mean when it comes to investing in dividends? And well, what are the different dividend packages available? How different are they? Without further ado, let's get started. Have you ever wondered how to attain financial goals with just $10,000? Can dividends truly make you rich? No doubt about it, the answer is yes. Dividend stocks are an excellent choice for investors seeking a simple way to make passive income. This is where a percentage of the profits made by publicly traded corporations are returned to investors as dividends. You can keep the money or invest it in additional shares. This plan prepares the groundwork for long-term success, lowers portfolio risk, and offers a steady income stream. The catch is that there are actually two methods of investing in dividends, each with unique features. The first strategy prioritizes consistency and stable returns while being low risk and low reward. This method is appropriate for those who favor a more cautious approach to investing. The second strategy, on the other hand, employs high-risk, high-reward tactics. While it necessitates a greater tolerance for risk, it also has the potential to yield substantial rewards. Let's now get into the most reliable and widely used dividend investing strategies. These ways will help you to maximize your $10,000 and guarantee a consistent income stream throughout your financial journey. Now, let's look at the first key player in this game. What do you think of dividend stocks? These unique equities function like money-making machines that routinely distribute a portion of a company's earnings to investors. Just think about getting paid for stock ownership. The majority of American dividend stocks make a set of distribution every 3 months, and some of the greatest ones even do so over time. It's like having a perpetual annuity. The fascinating part is that companies that pay dividends are frequently reputable and well-established. As a result, they are regarded as a low-risk investment. And guess what? The Standard & Poor's 500 Index, or S&P 500, has some of the best dividend payers. It's a posh grouping of around 500 of America's biggest and most successful companies. Now let's talk about numbers. In the S&P 500, the typical dividend yields ranges from 1.5 to 2%. You may be thinking, hey, that's not much. The truth is that several of the S&P 500 corporations have a track record of raising their dividends. Take Coca-Cola as an example. This multinational corporation, known for its well-known Coca-Cola drinks and other well-known trademarks, has a solid track record of giving its shareholders sizable dividend payments. Can you believe that they have consistently grown their payouts over 60 years? Now that's commitment. So let's do some math. If you invest $10,000 in Coca-Cola, which now has a dividend yield of 2.94%, you could make $294 in dividend income. Dividend stocks provide a steady source of income that stabilizes your investing portfolio. They can help you reach your financial goals, including debt repayment and future savings. Now, hold up. Before we go any further, let me just remind you to subscribe to my channel for all the latest tips and tricks on financial planning and budgeting. And guess what? In the description below, you'll find a link to my awesome monthly budget trackers. So click that subscribe button and check out those trackers. You'll be glad you did. Alright, let's get back to the content. Consider a group of dividend stocks that have accomplished something genuinely remarkable. They are referred to as the S&P 500 Dividend Aristocrats. These stocks are owned by S&P 500 index-compliant businesses that have increased their dividends continuously for a remarkable 25 years. What distinguishes these companies, though? Well, regardless of size, the index recognizes each as a distinct investment opportunity. Each business is given the same weight, showcasing its unique capabilities. And now for the fun part. Generally speaking, Dividend Aristocrat stock investments are quite secure. Why? Because they have been existing for at least 25 years and have proven to be stable and resilient. They frequently work in dependable sectors with a track record of profitability, dividend payments, and revenue development. One of these remarkable companies is the Johnson & Johnson, a member of the Dow Jones Dividend Aristocrats, who have been in business for almost 130 years. And get this, they have consistently increased their payouts for 60 years. It demonstrates their steadfast dedication to their stockholders. Johnson & Johnson now gives a 2.4% average dividend yield. Simply, if you put $10,000 into Johnson & Johnson today, you would get a consistent $240 a dividend each year. Now let's broaden our horizons and take a peek at a unique collective approach to dividend investing, the dividend exchange traded funds. Here, diversity meets dividend income. Now imagine a unique investment opportunity that offers consistency and significant yields. This is where dividend exchange traded funds come into play. These specialized funds are becoming increasingly popular among investors who wish to increase their income while maintaining the security of their holdings. Basically, the Dividend ETF puts together a collection of stocks noted for paying out large dividends. However, they don't end there. These ETFs also invest in preferred stocks and real estate investment trusts to increase the income potential. They provide a refuge of safety for those wishing to make some extra money. Look at the Invesco S&P 500 High Dividend Low Volatility ETF, or SPHD. This ETF concentrates on stocks that offer substantial dividend yields with little volatility. It concentrates on consumer defense and utilities, investing most of its capital in businesses included in the S&P 500 Low Volatility High Dividend Index. The yearly dividend yield of SPHD is about 4.6% as of June 2023. So if you put $10,000 into this ETF today, you could earn about $406 in dividends annually. It's like getting a second source of income every month. From exploring collective dividend income, let us delve into a more specialized approach focused on specific industries, sector ETFs. This is where fine-tuning investments meet lucrative dividends. In the world of investments, there is an intriguing option that allows you to generate extra money by focusing on particular industries. It is called sector exchange traded funds. Thanks to these innovative investments, you can invest in a particular industry, such as technology or energy, and possibly generate dividend income. Sector ETFs focus on particular sectors or businesses. They provide a focused approach to investing, allowing you to trade in narrowly defined industries and take advantage of trends and earning potential. Take the Vanguard Real Estate ETF as an example. This ETF tracks the performance of publicly traded equity real estate investment trusts and other real estate-related investments to deliver a high level of income and moderate long-term capital appreciation. Interestingly, the dividend yield for the VNQ was about 4.15% as of April 2023. So, if you put $10,000 into this ETF, you may earn $415 in dividends. It is like generating extra income simply by making real estate investments. You can access particular industries and potentially generate additional dividend income with the help of sector ETFs, which provide a focused and targeted approach to investing. They present an opportunity to match your investments with industries you believe in while opening up new opportunities to increase your wealth. After diving deep into sector-focused ETFs, let's shift our gaze towards a different yet equally fascinating investment avenue: real estate investment trusts. Welcome to the world where property and dividends merge. Real estate investment trusts may be the best option if you're trying to expand your real estate portfolio while earning some money. These companies own, manage, or finance real estate that generates income. They have a track record of generating strong returns through consistent dividend income and long-term capital growth. One benefit of investing in REITs is their potential for substantial dividend yields and steady, modest capital growth over the long term. Due to their minimal correlation with other assets, they are a great method to diversify your investment portfolio. They can possibly boost returns while lowering total portfolio risk. They are renowned for paying out substantial dividends. Each year, they must distribute at least 90% of their taxable income to shareholders. This is made possible by the consistent rental money received from their tenants. It should be no surprise retirees who depend on a consistent income stream and retirement savings choose REITs. For instance, consider Simon Property Group. a REIT specializing in retail properties. SPG had a noteworthy dividend yield of 6.56% as of April 2023. So if you invested $10,000 in SPG, you could earn $656 in annual dividend income. That is a way to have exposure to the real estate sector without the hassle of owning physical property. Now it's time to turn our attention to high-risk, high-reward strategies. Imagine getting close to $1,000 a year only from your investments. It is possible with high-yield dividend companies. Some investors have even amassed millions. But before entering this plan, research and seek advice from a financial expert. While receiving big profits may be alluring, exercising caution and avoiding believing empty promises is crucial. In greater detail, let us examine Altria Group Incorporated, a significant American company recognized for its tobacco and related products. Its remarkable dividend yield as of April 2023 was 8.46%. If you invested $10,000 in Altria, you may perhaps receive $846 in dividend income each year. That's a sizable return. Another example is the Energy Transfer LP, which transports natural gas and propane through pipelines. Its top dividend yield in April 2023 was 9.75%. Investing $10,000 into this company might earn you $975 in annual dividends. That is incredible. However, it is essential to diversify your portfolio regarding high-yield stocks to lower risk. By doing this, you can prevent yourself from being overly dependent on one stock. It is a wise move to safeguard your capital and be on the safe side. So what are your thoughts on the incredible potential of dividend income from a $10,000 investment? Will you embrace the dividend investing world and explore its diverse opportunities? Imagine the possibilities of growing your wealth while enjoying a steady stream of passive income. Go ahead, seize the opportunity, and let your money work for you. Thank you for watching, and please don't forget to leave a like and subscribe.